Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 346 on October the 25th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Iris Energy, Riot Platforms Inc, and the ARK Trust Innovation ETF, and we discuss three new trades on Canopy Growth Companies, the ProShares Trust 2 Ultra Bloomberg Natural Gas ETF, and the Ford Motor Company. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. And the equity markets had their first down week in 7 weeks. The Dow Jones Industrial Average lost 1,161 points, closing the week at 42,114 points. The S&P 500 index lost 56 points, ending the week at 5,808 points. And now it's time for the topic of the week. The topic of the week is trading a number or an event. Now, we're back in earnings season, so lots of companies have news coming up that the market is anticipating. If any of you are short Tesla or was this week, I'll offer my condolences. That was a very tough lesson to learn. That's a prime example, though, of what can happen after an earnings report. Even less than satisfying earnings numbers can lead to a strong bullish sentiment in the stock. For some companies, the earnings announcement will hardly move the stock even 10 cents. For others, the earnings announcement creates a high amount of volatility. I like to look at how the stock behaved after previous earnings announcements. After doing the research, you can figure out what type of trade would be the best to take advantage of the move. Some people buy strangles or straddles. Some people use debit and credit spreads with really wide strike differences. It all depends on how the company normally reacts to earnings announcements. And if you understand options well enough, you can be creative in designing the trade that'll give you the best possibility to make a profit from an earnings announcement. There were at least 4 companies this week with really attractive option pricing that I wanted to use it on today's show. Then I realized they all had earnings announcements before expiration. You have to keep track of that sort of thing so that you don't end up walking into a bad situation. So if the earnings announcement historically has meant an increase in volatility for the company, you'll want to create trades that can capture that price movement. This is often true with technology companies. Now, if the earnings announcement won't move the stock much at all, selling iron condors and other trades that benefit from low movement in the stock will lead to an ultimate profit. It's also important to know whether the stock tends to move the most before or after earnings. The old axiom, buy the rumor and sell the fact, still holds true in many situations. This will obviously affect your trade, so looking at past earnings announcements and studying how the stock responded afterwards can truly be a lifesaver for you. So during this earnings season, have fun, make money, and avoid landmines. A little research goes a long way. So that's it for the topic of the week. Let's go ahead and dive into the 3 trades we looked at from last week's show. Let's start off with our covered call on Iris Energy, symbol I as in India, R as in Romeo, E as in Echo, N as in November. At the time, the stock was trading for $9.53 per share. I looked at buying stock and selling the November 10 call at $1.15. That could give us a return of 17% in 4 weeks. Well, shares of Iris Energy ended the week at $9.25 per share, a loss of 28 cents. The call option we sold lost 25 cents, leaving us with a total loss of 3 cents if we were to close the trade out immediately. Now, a 3-cent loss does not justify making any adjustments on the trade so far. The stock price is still above the break-even point, which means we're still in a profitable zone if the stock were to expire at this current price. So far so good on this trade, but But we'd still prefer the stock to head higher again over the next 3 weeks until expiration. Just keep track of stock and have a plan ready for what you'll do if the stock continues to go lower. Next up, we have the credit spread on Riot Platforms Inc., symbol R as in Romeo, I as in India, O as in Oscar, T as in Tango. At the time, the stock was trading for $9.82 per share. I looked at selling the November 9/8 put spread at 34 cents. That could give us a maximum possible loss of 66 cents per spread. Well, shares of Riot Platforms lost 18 cents, ending the week at $9.64 per share. The out-of-the-money put spread that we sold is still out of the money, which means we're not losing on this trade even though the stock finished the week slightly lower. The stock price is 98 cents above our break-even point, a little more than 10% of the stock's whole value. So that's a good sign overall. No adjustments are needed at this point on the credit spread either. And then our final trade last week was a debit spread on the ARK Trust Innovation ETF, symbol A as in Alpha, R as in Romeo, K as in Kilo, K as in Kilo. At the time, the stock was trading for $48 per share. I looked at buying the November 47.48 call spread for 65 cents. That could give us a maximum gain of 35 cents, or that's a 53.85% return in 4 weeks. Well, shares of ARK fell 32 cents, ending the week at $47.68 per share. The in-the-money call spread that we bought is now just at the money. We have not passed the break-even point, but this trade has definitely taken a loss on the week. If we were to expire at the current price, we'd lock in 3 cents of profit, which isn't super inspiring at all. Now, we could alter the trade by turning it into a 50-cent wide spread. Before doing that, I'd like to give the stock a little room to head back a little higher, back up. We are 3 weeks away from expiration, so lots of green ahead of us, lots of time on the clock. Definitely want to keep track of the stock price and have a plan in case this stock does continue to go lower as well. So that's it for the review of last week's trades. Of course, all new trades on today's podcast will use the November 15th expiration for monthly options in November. So let's go ahead and get into the new trades for this upcoming week. We'll start off with the covered call, looking at Canopy Growth Companies, symbol C as in Charlie, G as in Golf, C as in Charlie. The stock ended the week at $5.44 per share. I'm looking at buying that stock and selling the November 5/2 call at 53 cents, hoping for a 12.68% return in 3 weeks. Now you enter this trade by buying stock for $5.44 per share and selling the November 5/2 call at 53 cents. This trade makes the most money if stock prices finish above $5.50 per share. The break-even price is $4.81 per share. And in real terms, the stock purchase will require $544, and you'll collect $53 for selling the option. Next up, we have the credit spread on the ProShares Trust 2 Ultra Bloomberg Natural Gas ETF, symbol B as in Bravo, O as in Oscar, I as in India, L as in Lima. The stock ended the week at $9.46 per share. I'm looking at selling the November 9/8/2 put spread at 20 cents. That could give us a maximum possible loss of 30 cents per spread. Now you enter this trade by selling the November 9 put at 68 cents and concurrently buying the November 8/2 put for 48 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $9 per share. The break-even price on this trade is $8.80 per share, and in real terms, you'll receive $20 per spread that you sell and have $30 at risk. And then our final trade on the week is going to be a debit spread on Ford Motor Company, symbol F as in Foxtrot. The stock ended the week at $11.07 per share. I'm looking at buying the November 10/2 11 call spread for 31 cents. That could give us a maximum gain of 19 cents, or that's a 61.29% return in 3 weeks. Now you enter this trade by buying the November 10/2 call for 88 cents and concurrently selling the November 11 call at 57 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $11 per share. The break-even price on this trade is $10.81 per share. In real terms, you'll pay $31 to enter the spread, and your maximum gain is $19 per spread. So that's it for the new trades for the week and the review of last week's trades. As a heads up, next week's show will be recorded on Thursday evening, October 31st, Halloween. Due to an event that I'm going to be a part of next weekend, it'll be hard for me to make a Friday night or weekend recording. So instead, just to be consistent and to give you guys what you listen for, I'm going to do it on Thursday night just to make sure I get it done for you. So that's it for this week's show. Thank you for listening as always. Thanks for the email you guys send. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.